I need you to stop watching the silver price. Stop listening to the analysts telling you the correction is over, and definitely stop believing that $83 silver was just a normal pullback. Because while you were staring at red candles in New York, the real move, the checkmate move, is happening right now in Beijing. The United States thinks it controlled the chaos yesterday by smashing the price, but China is preparing to flip the entire board over. It's Tuesday, February 3rd, 2026, and what I'm about to show you is not about silver anymore. This is about the end of the dollar as we know it, and it starts with a document published less than 48 hours ago that changes everything. Welcome to Currency Archive. Now, if you've been in the markets longer than most of these YouTube kids have been alive, if you remember when a handshake meant something, and when financial news wasn't just entertainment, then do me a favor, hit that subscribe button, not because I'm begging you, but because what we discuss here, you won't find on CNBC, and drop a comment below. Tell me where you're watching from. New York, London, Singapore, or maybe you're sitting in Texas right now wondering if your silver stack just became the smartest decision you ever made. Let's continue. On February 1st, 2026, something extraordinary happened that most people missed completely. While traders were watching silver prices swing wildly on their screens, while analysts were debating whether the correction was over, a document was published in Beijing that changed everything. The document appeared in Qiushi. Most Western investors have never heard of this publication, but they should have, because Qiushi is not just another magazine, it is the official theoretical journal of the Chinese Communist Party. When something appears in Qiushi, it is not an opinion, it is not a suggestion, it is a directive from the highest levels of the Chinese government. And what appeared in this February publication was a direct message from President Xi Jinping himself. The article had a simple title, but the words inside carried enormous weight. President Xi declared that China must build a powerful currency to challenge the dominance of the US dollar. He stated that the acceleration of the yuan's internationalization is now a national priority. He connected the strength of China's currency directly to the nation's financial security. This was not theoretical discussion. This was a declaration of war against dollar hegemony. Now, experienced analysts understand something crucial about Chinese government communication. The Chinese Communist Party does not make public statements casually. Every word in Qiushi is carefully chosen. Every article is reviewed at the highest levels. When President Xi publishes something in this journal, he is giving marching orders to every financial institution in China. History proves this pattern repeatedly. In 2013, Qiushi published articles discussing China's need for new international infrastructure. Within months, the Belt and Road Initiative was officially launched. Trillions of dollars began flowing into projects across Asia, Africa, and Europe. In 2020, Qiushi featured discussions about China's dual circulation economic strategy. Within weeks, that strategy became official policy. China began restructuring its entire economy to reduce dependence on Western markets. The pattern is clear. Qiushi articles are not predictions. They are announcements of decisions that have already been made at the highest levels. So when President Xi uses Qiushi to declare that China will challenge dollar dominance, when he explicitly links currency strength to national security, he is not floating an idea. He is announcing that the plan is already in motion. But here's where the story becomes fascinating. The timing of this publication was not random. This article appeared less than 48 hours after U.S. banks orchestrated a massive sell-off in precious metals markets. Silver had surged to unprecedented levels. Gold was climbing steadily. The paper markets in New York were showing signs of serious stress. COMEX inventories were draining. Margin requirements were being raised desperately. And then came the smash. Billions of dollars in paper contracts flooded the market. Prices dropped sharply. Mainstream analysts declared that the rally was over. They told investors that gold and silver were returning to normal levels. But Beijing saw something different. Chinese financial strategists understood that the price smash was not a sign of strength. It was a sign of desperation. The United States was defending the dollar with the only weapon it had left, creating unlimited paper contracts to suppress physical metal prices. So President Xi responded, not with paper contracts, not with currency manipulation, but with an official declaration that China would challenge the dollar system directly. This is asymmetric warfare at the highest level. The United States defends its currency with debt instruments, with derivatives, with the threat of military and economic sanctions. China is preparing to defend its currency with something the U.S. cannot print, cannot manipulate, cannot sanction away. Hard assets. Intelligence sources inside Shanghai's financial district are reporting something remarkable. The Qiushi article is not the end of this story. It is the beginning. Multiple sources suggest that China is preparing to make a massive announcement in the coming weeks or months. The announcement concerns China's official gold reserves. For years, China has reported its gold holdings in a way that serious analysts know is incomplete. The official numbers show modest increases, perhaps 27 tons added in a month here, 15 tons there. The total official reserve stands at around 2,264 tons. But everyone who tracks actual gold flows knows this number is fiction. When analysts examine Hong Kong import data, when they track Shanghai Gold Exchange delivery volumes, when they calculate China's domestic mine production and where that gold actually goes, the numbers tell a completely different story. The real accumulation is likely 10 times higher than official reports, possibly more. China has been moving thousands of tons of gold into off-balance sheet accounts, into military reserves, into sovereign wealth fund holdings that are not reported to the IMF. They have been accumulating in silence for over 15 years. And now, with the Qiushi declaration, the silence is ending. Western central banks are beginning to understand what is coming. They are reading the same signals. They see the same pattern that preceded every major Chinese economic move for the past 2 decades. China is preparing to reveal its hand. And when they do, the global financial system will never be the same. There is a building in Beijing that most people have never heard of. It sits in the Xiqing district, unremarkable from the outside. No dramatic architecture, no signs announcing its importance. Just another government office in a city full of government offices. But inside this building, something extraordinary has been happening for the past 15 years. This is the headquarters of the State Administration of Foreign Exchange, known as SAFE. And behind its quiet walls, analysts believe one of the largest wealth transfers in human history has been taking place. The story begins with a simple question. A question that has puzzled economists for over a decade. Where is all the gold going? The World Gold Council publishes data every quarter. They track mine production, they track imports and exports, they track central bank purchases. The numbers should add up. Supply should equal demand. But for China, the numbers have never added up. In 2009, China announced it held 1,054 tons of gold in official reserves. Then, silence for 6 years. No updates, no announcements. Just silence while the country quietly became the world's largest gold producer. While Hong Kong reported record gold import volumes, while the Shanghai Gold Exchange processed delivery after delivery. Finally, in 2015, China updated its official number. They now claimed 1,658 tons, an increase of 604 tons over 6 years. Analysts looked at this number and laughed, because during those same 6 years, Hong Kong alone had imported over 3,800 tons of gold into mainland China. Switzerland had shipped another 2,200 tons. China's domestic mines had produced roughly 2,400 tons that never appeared on export manifests. The mathematics was impossible. China was claiming they had accumulated 604 tons, while over 8,400 tons had physically entered the country with no record of leaving. Someone was lying. And it was not the customs data. This is where the story becomes a detective investigation. Researchers began mapping China's financial architecture. They discovered something fascinating. China does not have one central bank. It has a network of institutions that manage national wealth, each with different reporting requirements, each with different levels of transparency. The People's Bank of China reports official reserves to the IMF, but SAFE holds foreign exchange reserves separately. The China Investment Corporation manages sovereign wealth separately. The People's Liberation Army maintains strategic reserves that are never reported at all. It is a shell game, a perfectly legal shell game. Gold enters China through Hong Kong. The customs data is public, required by international trade law. But once that gold crosses into the mainland, it disappears into this network of institutions. Some gets reported to the People's Bank, most does not. Analysts began tracking the patterns more carefully. They noticed that every time gold prices dropped significantly in Western markets, Hong Kong import volumes surged. When Western investors were selling in panic, China was buying aggressively, but the official reserve numbers barely moved. They noticed that China's domestic gold mines, some of the largest in the world, were producing over 400 tons annually. Yet China never exported domestic production. Every ounce stayed inside the country. But official reserves increased by perhaps 100 tons per year at most. The gap kept growing. By 2020, independent researchers estimated that China had accumulated somewhere between 15,000 and 20,000 tons of gold in total holdings across all institutions. The official number was still under 2,000 tons. But then came the verification. In 2023, something unusual happened at the Shanghai Gold Exchange. A researcher noticed that the exchange had processed physical delivery of over 2,100 tons in a single year, yet inventories had not increased proportionally. The gold was being delivered, withdrawn, and moved somewhere else. Where was it going? The answer came from an unexpected source. A leaked internal document from a Chinese provincial bank showed instructions for handling special custody gold that was not to be reported on standard balance sheets. The gold was being transferred to safe accounts designated as strategic reserves. This was the smoking gun. China had built a parallel system. Official reserves reported to the IMF for international credibility, and in shadow reserves held in strategic accounts for the day when revelation became advantageous. Military analysts added another layer to the story. They pointed out that China's People's Liberation Army maintains strategic stockpiles of critical resources: oil, rare earth elements, copper, and almost certainly gold. Military reserves are exempt from civilian financial reporting. They are classified as national security assets. How much gold could be hidden in military accounts? No one knows. But consider this. The United States military held gold reserves during World War II that were never publicly disclosed until decades later. Russia's military maintained precious metal stockpiles throughout the Cold War that only became known after the Soviet collapse. China learned from both examples. The accumulation pattern shows sophistication that took decades to develop. This was not opportunistic buying. This was strategic planning at the highest levels, and now, after 15 years of silent accumulation, the Qiushi Declaration signals that the revelation phase has begun. The question is not whether China has hidden gold reserves. The question is how much and what happens when they finally reveal the truth. There is a room in Lower Manhattan that trades more gold in a single day than physically exists in most countries' entire reserves. This is the COMEX trading floor. And for decades, it has operated on a simple principle that most investors never questioned. Paper and physical are the same thing. A contract promising delivery of gold is treated as equivalent to actual gold sitting in a vault. Traders buy and sell these contracts millions of times, but less than 1% ever results in actual metal changing hands. The system works because everyone agrees to pretend that paper equals metal until someone demands the metal. This is where China's strategy becomes devastating. Imagine the scenario. China calls a press conference. The announcement is simple. They are updating their official gold reserve figures to comply with IMF transparency standards. The new number is not 2,264 tons. It is 18,000 tons. What happens next is not speculation. It is mechanical, predictable, inevitable. Within seconds of the announcement, currency traders around the world recalculate everything. The yuan is no longer a currency backed by nothing. It is now backed by the second or third largest gold reserve in the world, possibly larger than the United States claims to hold. The yuan-dollar exchange rate begins moving immediately, but the real chaos begins in the derivatives markets. There are currently over 500,000 open gold futures contracts on COMEX. Each contract represents 100 ounces. That is 50 million ounces of paper gold, roughly enough 5 tons. The entire registered inventory available for delivery on COMEX is approximately 350 tons. The ratio of paper claims to physical metal is over 4 to 1. This ratio exists because the system assumes that most contracts will be settled in cash. Traders do not want actual gold. They want price exposure. They want to speculate. So COMEX operates with fractional reserves, just like a bank. But what happens when that assumption breaks? When China reveals 18,000 tons of hidden reserves, sophisticated investors immediately understand something critical. If China has been accumulating that much gold in secret, they understand the difference between paper and physical. They understand that paper contracts can be printed infinitely. Physical metal cannot. These investors begin demanding delivery. Not all of them, just a fraction. But that fraction is enough. If just 20% of COMEX contract holders demand physical delivery instead of cash settlement, the exchange cannot fulfill the requests. There is not enough registered inventory. The fractional reserve system collapses. COMEX has emergency procedures for this scenario. They can declare force majeure, they can settle contracts in cash at whatever price they choose, they can change the rules. But changing the rules proves China's point. It proves that Western markets are not free markets. They are managed markets. And when pressure becomes too great, the managers simply change the rules to protect themselves. This is the asymmetric warfare strategy. China does not need to attack the dollar with military force. They do not need to dump U.S. Treasury bonds. They simply need to reveal the truth and let market mechanics do the rest. Because once COMEX proves that paper and physical are not the same thing, once they prove this by refusing delivery or forcing cash settlement, every other paper market comes under suspicion. Investors begin questioning everything. If gold futures are not backed by real gold, what about silver futures? What about oil futures? What about government bonds that promise future payment? Are those backed by real productive capacity? Or are they also paper promises in a fractional reserve system? The contagion spreads through market psychology. Institutional investors manage trillions of dollars. They have risk committees. They have compliance departments. They have fiduciary responsibilities. When a major market proves unreliable, these institutions must reduce exposure, not because they are panicking, because their internal rules require it. So they begin rotating capital out of dollar-denominated assets into hard assets, into currencies backed by commodities, into anything that cannot be printed or manipulated by rule changes. This rotation does not happen in one day. It happens over months. But the direction becomes inevitable once it starts. Central banks face an impossible choice. They can defend their currencies by raising interest rates dramatically. But this crashes their economies and triggers debt crises. Or they can print more money to buy bonds and support markets. But this proves that the currencies are indeed backed by nothing, which accelerates the rotation away from those currencies. There's no good option. This is why China waited 15 years to make this move. They needed to accumulate enough gold that the revelation would be undeniable. They needed to build alternative payment systems so their economy could function outside dollar networks. They needed to wait until Western economies were vulnerable, drowning in debt with no room to maneuver. Now all the pieces are in place. The Qiushi Declaration was the warning shot. The reserve revelation will be the killing blow, and it will not require a single bullet fired, not a single sanction imposed, not a single trade war escalation, just the truth, spoken clearly, backed by metal that cannot be argued with. That is the mechanism. That is the checkmate. There's a moment that comes in every major financial shift when the smart money moves and everyone else watches in confusion. That moment is now, but understanding what to do requires understanding what is actually happening. Not the headlines, not the analyst predictions, the actual mechanics of what comes next. The first thing serious business leaders need to recognize is the timeline. China does not announce strategies like this unless implementation is already underway. The Qiushi Declaration means the machinery is already moving, but major announcements of this magnitude follow diplomatic protocols. They happen at international forums where maximum attention is guaranteed. The next G20 summit is scheduled for November 2026. The BRICS annual meeting happens in August. The Shanghai Cooperation Organization Forum meets in September. Any of these events could serve as the stage for China's reserve revelation. This gives business leaders a window, not years, not decades, months. What happens during this window matters enormously. The businesses that survive the coming transition will be those that prepared while uncertainty still existed. The businesses that fail will be those that waited for certainty. And by the time certainty arrived, the opportunity to prepare had already passed. So what does preparation actually look like? It begins with currency exposure assessment. Any business holding significant dollar-denominated debt needs to model what happens when the dollar weakens against hard asset-backed currencies. The debt does not disappear, but the revenue to service that debt might be coming in yuan or rupees or currencies that strengthen relative to the dollar. The math changes. Cash flow projections that looked sustainable suddenly look dangerous. This does not mean panic selling or restructuring overnight. It means running the scenarios now. It means understanding the vulnerability points. It means having conversations with lenders about flexibility before flexibility becomes unavailable. It means stress testing business models against a world where the dollar is no longer the automatic reserve currency. The second layer is supply chain analysis. For the past 50 years, international trade has operated on a simple assumption. Transactions settle in dollars. Contracts are written in dollars. Even when Chinese factories sell to European buyers, the transaction often moves through dollar clearing systems. But China has spent the last decade building alternative systems. The cross-border interbank payment system, CIPS, now processes trillions in yuan-denominated transactions. The digital yuan is already operational in multiple countries. Belt and road infrastructure projects increasingly settle in local currencies or yuan. These systems exist in parallel to dollar networks right now. They are smaller, less established, but they are operational. When China reveals its gold reserves and begins pushing yuan internationalization aggressively, these alternative systems will scale rapidly. Businesses that have already established relationships with Chinese suppliers using yuan settlement will have options. Businesses that have exclusively dollar-based supply chains will find themselves negotiating from weakness. The preparation is not switching entirely to yuan. The preparation is building optionality, so that when the transition accelerates, the business is not caught with only one payment pathway. The third element is asset allocation strategy. Central banks are already showing their hand. They have been net buyers of gold for 14 consecutive years. Not because they suddenly became gold enthusiasts, because they understand monetary history. Every previous shift in global reserve currency status involved hard asset revaluation. When the British pound lost reserve status, gold repriced. When Bretton Woods collapsed in 1971, gold repriced. When currencies decoupled from fixed exchange rates, hard assets repriced. The pattern is consistent across centuries. Businesses do not need to become commodity speculators, but they need to understand that cash sitting in bank accounts is an asset position, and that position carries risk in a currency transition. Holding some percentage of liquid assets in physical commodities, in precious metals, in hard assets that cannot be devalued by monetary policy is not paranoia. It is risk management based on historical precedent. The fourth consideration is market positioning. When Nixon closed the gold window in 1971, markets did not crash immediately. There was confusion, volatility, denial. Many investors convinced themselves it was temporary, that normalcy would return. But the investors who understood that the monetary system had fundamentally changed, who positioned accordingly, saw wealth multiply over the following decade, while others suffered through stagflation and currency debasement. This moment feels similar. Most market participants are treating the current volatility as temporary. They believe central banks will stabilize prices. They believe the dollar system is too entrenched to change. They believe China is bluffing. But the evidence suggests otherwise. The Qiushi declaration is not a bluff. The gold accumulation is not a bluff. The alternative payment systems are not a bluff. These are infrastructure projects that took 15 years to build. China does not build infrastructure for 15 years and then abandon it. So the question for business leaders is not whether change is coming. The question is whether they will prepare while preparation is still possible, or wait until change becomes undeniable and preparation becomes impossible. History shows that the cost of early preparation is always smaller than the cost of late reaction. The warning has been issued. The timeline is measurable. The mechanism is understood. What happens next is a choice.